Good evening to all students. I am Dr. Suma Devi, Associate Professor, PG and Research Department of Economics, Sri Sharda College for Women, Salem. Today, I am going to take class on the topic revenue and revenue curves. Revenue is the money generated from normal business operations and it is calculated by multiplying the average sales price by the number of units sold. And it is the top line or gross income figure from which costs are subtracted to determine net income. Revenue is also known as sale proceeds. Meaning of revenue. Revenue is the money flowing into a business over a given time period from selling goods and services in market. It is also known as turnover. The main component of revenue is the quantity sold multiplied by the price. The formula for calculating total revenue is equal to quantity sold into unit price, or TR, which is equal to Q into P, since P is equal to average revenue. For example, if a company sells 10 computers at rupees 50,000 each, its gross revenue is equal to 50,000 into 10, which is equal to 5 lakh rupees. This chart shows the types of revenue. Under types of revenue, we have total revenue, average revenue, and marginal revenue. The formula for calculating average revenue is TR by Q. The formula for calculating total revenue is P into Q. And the formula for calculating marginal revenue is TR of n units minus TR of n minus 1 units, or delta TR by delta Q. Then we will move on to total revenue. The formula for calculating total revenue is price per unit into quantity, or average revenue into output, which is denoted by AR into Q. Example, the shopkeeper sells 70 books at rupees 30 each. The formula is price per unit into quantity, that is P into Q. 30 rupees into 70 books, you will get rupees 2100 as total revenue. Meaning of average revenue. Average revenue is the revenue earned per unit of output. It can be obtained by dividing the total revenue by the number of units of output sold. The formula is total revenue by total output sold, which is equal to TR by Q, where AR stands for average revenue, TR stands for total revenue, Q stands for total output produced and sold. Example, when total revenue is rupees 100, producer is selling 10 units of the product, then AR, which is equal to TR by Q, that is 100 divided by 10, you will get rupees 10 as average revenue. Meaning of marginal revenue. Marginal revenue or marginal benefit is a central concept in microeconomics that describes the additional total revenue generated by increasing product sales by 1 unit. Marginal revenue is the increase in revenue from the sale of one additional unit of product, that is, the revenue from the sale of the last unit of product. It can be positive or negative. Marginal revenue is an important concept in vendor analysis. It is a fundamental tool for economic decision making within a firm's setting together with marginal cost to be considered. Definition of marginal revenue. Marginal revenue is the addition made to the total revenue by selling one more unit of output. MR, which is equal to delta TR by delta Q, where MR is marginal revenue, delta TR is change in total revenue, and delta Q is change in output. Example for calculating marginal revenue is, if a firm sells 20 units of books and the price of one unit of book is rupees 50, then its total revenue is P into Q, which is equal to 20 into 50, you will get 1000. Then, if the firm increases quantity sold to 21 units of books at rupees 49 each, then its total revenue is P into Q, which is equal to 21 into 49, you will get 1029. Therefore, by using the formula, rupees 1029 minus rupees 1000 divided by 21 books minus 20 books, you will get rupees 29 as marginal revenue. Thus, MR, which is equal to delta TR by delta Q, indicates the slope of the total revenue curve. If the total revenue curve is given, one can find out the marginal revenue at various levels of output by measuring the slopes at the corresponding points on the total revenue curve. This table shows the calculation of TR, AR and MR. Here we have number of units sold, which is denoted by Q, and price of the product, which is denoted by P. By using the formula, we are calculating total revenue, average revenue and marginal revenue. When 1 unit of the output is sold at rupees 16, total revenue is 16 and average revenue is also 16. And for calculating marginal revenue, you have to find out the difference between the two successive total revenue. Likewise, we have to calculate total revenue, average revenue and marginal revenue for the remaining units. This table shows the derivation of total revenue, average revenue and marginal revenue under imperfect competition. In the table, when the price is falling as additional units of the goods are sold, MR can be calculated by taking out the difference between the two successive total revenues. Thus, when 1 unit of the output is sold, total revenue is rupees 10. When 2 units are sold, price falls to rupees 9 and TR is equal to rupees 18. MR is therefore equal to 18 minus 10, which is 8, which can be recorded in the fourth column. MR is positive as long as TR is increasing. MR is negative when TR declines. As seen in the table, when quantity sold is increased from 6 units to 7 units, the total revenue declines from rupees 30 to rupees 28 and marginal revenue is equal to minus 2 and so on. This diagram shows the shape of total revenue, average revenue and marginal revenue curves under imperfect competition. TR curve is the total revenue curve, and when TR is maximum, marginal revenue is 0. When TR starts declining, marginal revenue will be negative. And AR and marginal revenue curve under imperfect competition is negatively sloped. In all forms of imperfect competitions, that is monopolistic, oligopoly and monopoly, the AR curve facing an individual firm slopes downward. This is because when a firm lowers the price of the product, the quantity demanded and sales would increase and vice versa. TR, AR and MR under perfect competition. Under perfect competition, demand curve is perfectly elastic. AR remains constant. MR will be equal to AR if the price of the commodity remains the same and hence AR coincides with MR. This is because if one more unit is sold and the price does not fall, the addition made to the total revenue by that unit will be equal to the price. Since no loss in revenue is incurred on the previous units. This table shows the derivation of total revenue, average revenue and marginal revenue under perfect competition. Under perfect competition, average revenue is equal to price, which is equal to marginal revenue. As shown in the table, the price is constant at rupees 10 for all units. Hence, the AR is also constant at rupees 10. The TR is increasing at constant rate with increase in units of sale. It goes on increasing by rupees 10 with every increase in units of sale. MR is the change in TR. Therefore, MR is constant at rupees 10. Hence, AR and MR are equal and constant at every unit. This diagram shows the shape of the total revenue, average revenue, marginal revenue curves. X-axis represents units of sale and Y-axis represents revenue. TR is the total revenue line and AR, MR and price are horizontal line which is parallel to X-axis. Under perfect competition, when an individual firm's average revenue or price remains constant and marginal revenue is equal to average revenue as shown in the diagram. Total revenue curve is a straight line from the origin. Average revenue curve is horizontal straight line which is parallel to x-axis or perfectly elastic. Then we will move on to the shape of the average revenue and marginal revenue curves under perfect monopoly and monopolistic competition. AR curve of the firm under perfect competition. The average revenue curve is perfectly elastic under perfect competition. It means that a firm can sell any amount of the commodity at the prevailing price. Firm's average revenue curve is indicated by the straight line which is parallel to x-axis. In the diagram, x-axis represents the output and y-axis represents the price. AR is the average revenue curve and which is perfectly elastic under perfect competition. Shape of the average revenue curve of the firm under monopoly competition. The average revenue curve for a monopoly firm is downward sloping as any increase in price will cause the quantity demanded to decline and it is less elastic. In the diagram, x-axis represents the output and y-axis represents the price. And average revenue curve is less elastic under monopoly competition. Average revenue curve of the firm under monopolistic competition. The firm faces a negatively sloped average revenue curve. It means that a large quantity of the commodity can be sold only by decreasing its price. The average revenue curve is also more elastic because of the availability of close substitutes in the market. And in the diagram, x-axis represents the quantity and y-axis represents the price. And here, the shape of the average revenue curve is negatively sloped. This diagram clearly distinguishes the shape of the average revenue curve under perfect competition, monopoly competition, and monopolistic competition. Under monopoly competition, the shape of the average revenue curve is less elastic. And under perfect competition, the shape of the average revenue curve is perfectly elastic. And under monopolistic competition, the shape of the average revenue curve is more elastic. These are all the exercises that you have to do by yourself, students. First, the seller sells 500 boxes of pencil at rupees 250 each. Calculate the total revenue. When total revenue is rupees 500, The seller is selling 100 units of the product. Calculate its average revenue. A company sells its first 100 items for a total of rupees 1000. If it sells the next item for rupees 9, calculate the marginal revenue. And these are all the possible questions. State the meaning of total revenue. Define the meaning of average revenue with the help of the diagram. Diagrammatically discuss the meaning of marginal revenue. Illustrate the relationship between TR, AR and MR. And these are all the references, students. Thank you.